Okay, hi everyone, good morning. Welcome to today's webinar on making tax digital for income tax. So I'm Nicola Hageman from the Numbers Quarter, and I am really pleased that you've joined us today for what I think is going to be quite an essential session for anyone that's involved with self-employment or property rental. So before we begin, I will just quickly cover some housekeeping rules. Items. This session is being recorded, so don't worry, we will send it to all attendees afterwards and anyone that registered. Please feel free to use the chat function, as I say, throughout the presentation to ask questions. I will be looking at these at the end, going through that for our Q&A session. If you've got any questions in there, please do put them in. If you are experiencing any technical difficulties, if you can't hear me, again, put them in the chat and Rosie is monitoring that. So you should be able to get an answer as well. So today's session is quite timely. I know that HMRC have been sending a lot of letters out recently, and obviously April is not far away. So we are very close to this significant change in how sole traders and landlords are going to need to report their income to HMRC. This is one of the biggest changes to self-employment and property tax that we've seen in ages, in decades probably. So it is very important to understand where you fall into the situation and how you need to deal with it. So I know many of you may be feeling uncertain or anxious about these changes. It's completely understandable because change can be daunting, especially when it involves something as important as your tax obligations. I want to reassure you that by the end of today's session, you should have a clear understanding of what MTD for ITSA means for you, whether you need to comply, and most importantly, how you can prepare for these changes. So I do have a comprehensive agenda today that we're going to be going through. We're going to start by explaining exactly what MTD for ITSA is, why the government is implementing it, and then we'll look at who is going to be affected and when. I'm then going to have a look at the practical aspects of what qualifying income is, what the key requirements are, and the timeline for implementation as well. I'm also going to look at some exemptions, special circumstances, and I'll show you through some software options and look at some your action plan for the future for getting this up and running. So as I say, throughout this session, please, I encourage you, have a think about your own situation, look at your current income levels and how you currently manage your records. Then what questions you might then have about the transition. Remember, there's no such thing as a silly question when it comes to tax compliance. The silly ones are easy for me to answer, so I love them. Okay, let's have a look and we'll start going through for MTD. So let's start with the fundamentals. Making tax digital for income tax is a government initiative designed to transform how sole traders and landlords report their income and expenses to HMRC. It's part of a broader digital transformation strategy that aims to make the tax system more efficient, reduce errors, and provide real-time visibility of the taxpayer's financial positions. So the concept isn't entirely new. Some of you may already be familiar with making tax digital for VAT. This has been in operation since 2019, and MTD for ITSA follows a very similar principles, but it does apply specifically to income tax for self-employed individuals and property landlords. So at its core, MTD for ITSA is built around three fundamental changes to how you are going to interact with HMRC. First, we have to have the move to digital-first record keeping. So this means saying goodbye to shoeboxes full of receipts and handwritten ledgers. Instead, you are going to need to maintain your income and expense records using compatible software. Now, this doesn't necessarily mean expensive, complex systems. There are many affordable and user-friendly options available, and I will discuss that with you later in today's session. The second major change is the introduction of quarterly updates. So rather than submitting all your information once a year with your self-assessment return, you are going to need to provide HMRC with summary information about your income and expenses every 3 months. Think of these as like a progress report rather than full tax returns. They're designed to give HMRC a more current view of your financial position throughout the year. At the moment, you won't be paying tax based on these reports. You'll still stick with the January, July payments on account, but I imagine at some point in the future, they will look at using these for tax positions as well. And then the third key element is the real-time view that this provides to HMRC. So by receiving regular updates throughout the year, HMRC can better understand your tax position as it develops, rather than waiting until the tax year ends. This should, in theory, lead to fewer surprises and better support for taxpayers. So it is important to understand that MTD for ITSA isn't just about technology for technology's sake. The government believes that this approach will reduce errors in tax returns, make it easier for taxpayers to stay on top of their obligations, and ultimately create a more efficient tax system for everyone. Okay, so now we know what MTD for ITSA is, let's look at who will be affected. This is probably the most important question for many of you today. So do these changes apply to me? The requirements for MTD for ITSA are quite specific, and you must meet all of the following criteria to be required to comply. First of all, you must be an individual registered for self-assessment. So this means the requirement to apply will apply to sole traders and individual landlords. It does not apply to companies, partnerships, or trusts. So if you operate through a limited company, these particular rules do not apply to you, although obviously companies have their own reporting requirements. Secondly, you must receive income from self-employment or property, or both. This includes income from any trade, profession, or vocation that you carry out, as well as rental income from the UK or foreign properties. So it is worth noting that this applies whether you have one rental property or multiple properties, and whether your self-employment is your main source of income or just a side business. The third and crucial criteria is the income threshold. So this is where the phased implementation becomes important. So from April 26, you will need to use MTD for ITSA if your qualifying income exceeds £50,000. From April 27, the threshold reduces to £30,000, and from April 28, it reduces further to £20,000. But here's a critical point that often causes confusion. These thresholds are based on your income in the previous tax year. So for April 26 start, HMRC will be looking at your 24-25 self-assessment return, which we're currently submitting for our clients now and need to be submitted by the 31st of January 26. So if your qualifying income for that year exceeds £50,000, you will have to start using MTD for ITSA from the 6th of April 2026. And this is why it's really important to get your self-assessment returns done early so that you know whether you are therefore within or outside of MTD for ITSA from April. It's also worth noting that HMRC will assess your position automatically based on your self-assessment return. So you don't need to apply to join for the MTD for ITSA. If you meet the criteria, HMRC will notify you that you need to comply. So there is an important distinction to make here. While these are the mandatory thresholds, you can choose to opt into MTD for ITSA voluntarily, even if your income is below the relevant thresholds. Some people are going to find this helpful for getting familiar with the system before it becomes mandatory for them, or they might prefer the discipline of quarterly reporting. So what exactly qualifies as qualifying income? This is crucial to understand because it determines whether and when you'll need to comply with MTD for ITSA. So qualifying income is essentially the total income that you receive in a tax year from self-employment and property before any expenses are deducted. The key word here is gross income. HMRC looks at your turnover, not your profit. So let's break this down to what is and isn't included. On the included side, we've got your self-employment income. This covers your gross turnover from any business that you operate as a sole trader, whether you're a consultant, a tradesperson, a retailer, or any other type of business operator. All of your business income counts towards the threshold. It doesn't matter if you've got one business or multiple, they all count together. And then property income is also included. This covers rental income from UK properties and foreign properties. So if you own rental properties jointly with someone else, such as your spouse or business partner, you include your share of the rental income. So if your property is 50-50 with your partner, it generates £20,000 a year in rental income. Your share and your qualifying earnings for that would be £10,000. As again, it is important to note that it's both UK and foreign income. So if you have a holiday home in Spain that you rent out, that income also needs to be included in the calculation. So let's look at what's excluded from the qualifying income, because this also sometimes gets a bit confusing. So employment income doesn't count. Even if you have a PAYE job alongside your self-employment or property income, your salary or wages do not contribute to the qualifying income threshold. This is very important for people who may have a portfolio and careers, or who are building a business while still employed. Partnership income is also currently excluded. So if you're a partner in a business partnership, the income that you receive from that partnership doesn't count towards your MTD for ITSA threshold. Partnerships do have their own digital reporting requirements, but as I say, they get submitted separately. And investment income, such as dividends from shares or interest from savings account, also don't count towards the threshold. So if you're a director of a limited company, you don't include your dividend income when you're calculating your threshold. So let me give you a quick practical example just to illustrate this. We've got a guy who works part-time as an employed project manager, earning £25,000 per year. He also runs a consultancy business as a sole trader, and this generates £20,000 in turnover. And he owns a rental property that produces £15,000 in rental income. So although his total income is over that threshold, his qualifying income is only £35,000 because it's the 20 from self-employment and the 15 from the rental. His employment income does not come into that and does not count to the threshold. So in this example, you wouldn't need to comply with MTD for ITSA from April 26 because it's below the 50,000, but you would need to comply from April 27 when that threshold reduces down to £30,000. So this is why it's really important to monitor your income levels and plan ahead. Your circumstances can change, and what doesn't apply to you today might apply to you next year. So now we know who's affected and how qualifying income works, let's look quickly at the practical requirements of MTD for ITSA. So what will you actually need to do differently? There are 4 key requirements that represent significant change from the current system. The first requirement is digital record keeping. This is perhaps the biggest change for many people. You are going to need to use compatible software to maintain your income and expense records. This software must be able to connect to HMRC's system and submit the required information electronically. Now, I want to be clear about what this means in practice. You don't need to become a technology expert overnight. The software that's available ranges from very simple, affordable apps that you can use on your phone or your tablet to more comprehensive accounting packages. The key here is that whatever you choose, it must be MTD compatible and be able to store your records digitally. So this means if you currently keep paper records, write everything in a notebook, or use a basic spreadsheet, you are going to need to change your approach. However, this doesn't mean that you'll need to throw away every receipt. You can still collect paper receipts, but you need to enter the information into your digital system or use software that can scan and process receipts automatically. So the second requirement is the quarterly updates. So instead of reporting everything once a year, you are going to need to submit a summary information to HMRC every 3 months. Now, these updates need to be submitted with 1 month of each quarter end. So the deadlines are the 7th of August, the 7th of November, the 7th of February, and the 7th of May. So it is important to understand that these quarterly updates are not full tax returns. They are summaries showing your total income and your expenses for the quarter. So you don't need to provide detailed breakdowns of all the supporting documentation with these updates. Think of them as kind of like a progress report for HMRC, and then you've got a final declaration, which I'm coming on to at the end of the year. So as I say, the third requirement is your final declaration. You still need to submit an annual declaration, which is very similar to your current self-assessment return, but it's got to be now done through your MTD compatible software. The final declaration is where you're going to be making any final adjustments, claiming reliefs or allowances, and you would calculate your final tax liability. This is still due by the 31st of January following the end of the tax year. The fourth requirement is software integration. So again, your chosen software has got to be able to connect directly to HMRC's system to submit your quarterly updates and final declaration. This happens automatically through secure digital connections, so you don't need to worry about manually uploading files or visiting HMRC's website to submit the information. Now, I know this might sound overwhelming, but remember that millions of businesses are already using similar systems for MTD for VAT, and we use software for most of our clients now as well to keep track of their income and expenses. So it's something that we are used to using. The feedback's generally been positive once people get used to the new processes. And the key is to start preparing now. You don't need to wait until April 26 to begin using digital record keeping. In fact, I strongly recommend starting as soon as possible so that you can get comfortable with the new system and the new processes, whilst you've still got that safety net of your current system. So, whilst MTD for ITSA will apply to most sole traders and landlords, there are some exemptions and special circumstances that might apply to your situation. So the most straightforward exemption is the income threshold. So if your qualifying income is below the threshold, you do not have to register for MTD for ITSA. You can continue with the traditional self-assessment processes. I did say earlier on, though, that you may decide to register voluntarily because it will give you that up-to-date system. You will get to know your income and expenses levels for the full year as you're running through your year. So no surprise tax bills at the end of the year. The next exclusion is a digital exclusion exemption. So if you can demonstrate that it's not reasonably practical for you to use digital tools to comply with MTD for ITSA, you may be able to apply for an exemption. So this might apply if you've got limited digital skills, if you lack access to reliable internet, or you have certain disabilities that make using digital systems difficult. However, it's important to understand that this exemption isn't automatic. You would need to apply to HMRC and demonstrate why digital compliance isn't reasonably practical for you. HMRC will consider every case individually, and they may suggest alternative solutions, such as using an agent or accessing support services before granting the exemption. Another exemption relates to the MTD for VAT. So if you're already exempt from MTD for VAT due to digital exclusions, this exemption automatically applies to MTD for ITSA as well. You don't need to apply separately. If you're a non-resident landlord, the rules still apply to you if you meet the income thresholds. However, there may be additional circumstances around how you submit your information, particularly if you don't have a UK address or a UK bank account. So it is worth noting that exemptions are reviewed regularly and your circumstances might change. So if you're granted an exemption now, you should review your situation annually to ensure that you still qualify. If you think you might qualify for an exemption, I'd strongly recommend seeking professional advice. The rules can be complex and it is important to understand your options before making any decisions. Remember, even if you qualify for an exemption, you might still choose to use MTD for ITSA voluntarily. Many people find that digital record keeping makes managing their finances easier, even if they're not required to use it. Okay, so one of the most common questions that I am getting at the moment is what software do I need and how do I choose? So the good news is there's plenty of options, but the simplest and most effective route for most small businesses today is cloud-based software with an easy mobile app. So cloud software like Xero, FreeAgent, QuickBooks Online, they all run through your web browser so that you can log in from anywhere. It updates automatically, backs up your data and connects to your bank account and makes it really easy for you or your accountant or bookkeeper to see the same information in real time. That time saving reduces errors and it means no more worrying about emailing spreadsheets back and forth. On top of that, these systems usually come with easy to use apps for your phone or your tablet. That means you can take snap photos of your receipts when you get them. You can keep track of expenses on the go. You can connect to your bank account and you can even send invoices to your clients directly from the apps. This keeps your records up to date and it becomes something that you can do in a couple of minutes here and there rather than a big job at the end of the year. So some people still use desktop software, which you can install on your computer and run locally. It can be useful if you don't have reliable internet, but you need to manage your own updates and backups, and it doesn't give the same access or collaboration. For most people now, it's becoming less practical compared to these online systems. So whatever you choose, the most important thing is that the software must be MTD for ITSA compatible, meaning that it can submit your quarterly updates directly to HMRC. So HMRC do have a list of compatible software on their website and we can help you check what's right for you. My advice is to start by thinking about your needs. Do you want simple record keeping or do you also need invoicing, project tracking, reporting? Then use these to shortlist 2 or 3 options that fit your budget. Test them with free trials and see which feels easiest to use day to day. And remember, you're not locked in forever. It's about choosing the tool that makes it easy to stay compliant and gives you the visibility that you need to run your business well. The 2 softwares that we're suggesting people look at are FreeAgent, because you can get that free with a Metal or a NatWest account, and also Xero. So if you want something that's a little bit more, a little bit more, has a bit more reporting, has a bit more availability, have a look at Xero as well. We've got a couple of options for you, and I'm happy to discuss those with you. So let's talk about the practical steps to prepare for MTD for ITSA. The key, again, is to start early and take a systematic approach. Step 1 is to assess your current position. Start by calculating your qualifying income for the current tax year. So we are looking, as I say, at 24-25 to see whether you are going to be starting from April 26. If you've already done your self-assessment return, you will know your figures. If you haven't done it yet, then I recommend getting it done soon, having a look and see what that turnover looks like. Again, it's your self-employment income and your property income, and you can project then what your total might be for the current tax year as well, so that you know when you are going to be have to enrol for MTD for ITSA. I would suggest number 2 to review your current record keeping processes, how you currently track your income and expenses. So do you use paper records or spreadsheets, or are you already on some software? So understanding your current approach will help you plan the transition to digital record keeping. Also consider your business structure and whether there are any changes that you might want to make. For example, if you're close to the income threshold, you might want to discuss with your accountant whether incorporating as a limited company would be beneficial. Step 2 is choosing and implementing the software. So based on what we discussed in the previous section, research your options and select your MTD compatible software that meets your needs and your budget. Don't wait until you're required to do MTD for ITSA to start using the software. Begin using it now, even if you're still maintaining your existing records as a backup. This will give you time to get comfortable with the new system and work out any issues before you're relying on it for compliance. Test the software thoroughly, enter some real transactions, generate reports, and make sure that you understand how to use all the features that you're going to need. If the software can connect your bank account, set this up and test it. Step 3 is to digitize your records. So if you currently use paper records, you will need to establish your digital filing system. This doesn't necessarily mean scanning every receipt, but you do need to ensure that all of your income and expenses are captured digitally. Set up a system for handling receipts and invoices. As I said earlier, some software can scan and process receipts automatically, whilst others do require manual data entry. Find an approach that works for you and stick to it consistently. And then establish backup procedures. Even though cloud-based software typically includes automatic backup, it is good practice to export your data regularly and store copies securely. And then step 4, this is getting support and training. Don't try to do everything yourself. Consult with your accountant or your bookkeeper about the transition. We can help you we can provide you with valuable advice on software selection, help you with setup, and ensure that you're capturing all the information that you need for tax compliance. Consider attending training sessions or workshops. Many software providers are offering training, and organisations like ours are going to be running regular sessions to help you prepare for MTD for ITSA. Establish ongoing support contacts. So make sure that you know who to call if you have a problem with your software or a question about your compliance requirements. So my timeline for you: start immediately. Don't leave it until the last minute. In the next kind of couple of weeks, start reviewing your current income and assessing whether you'll need to comply. Research your software and begin testing solutions. And then over the next 6 months, select your software, begin using it alongside your current system, and start digitizing your record keeping process. If you've got staff, make sure that they're trained on all the new systems. And then before April 26, complete your system setup, test your quarterly submission process, and ensure that you're fully ready for compliance. Remember, you can start using MTD compatible software and digital record keeping immediately, even if you're not yet required to comply. This voluntary early adoption can help you get comfortable with the new processes and identify any issues while you still have time to resolve them. So we are coming to the end of the webinar now, so please make sure that you've got any questions in the chat box for when I come to that next. I just wanted to walk you through the 3 ways that the Numbers Quarter can help you with making tax digital for income tax. Obviously, if you're a current client with us, we will be having conversations with you anyway, but just as an idea of the support that we can offer you. So the first option is a DIY plus year end. So with this, you take care of your own quarterly submissions using the HMRC recognised software. For example, FreeAgent, which I say you can get free with a Metal or NatWest account. And then at the end of the year, we step in, review the figures, make any adjustments that are needed, and submit your final declaration. kind of like we do now with the self-assessment returns. So this is a good fit if you're confident keeping your own records and you just want us to check things over at the end. The second option is the full compliance. So here we will take the quarterly submissions off your hands as well. So we'll prepare and file all 4 quarterly updates for you and complete your final declaration at the end of the year. You'll also get an annual review call so that you can check everything is on track. This is great if you prefer peace of mind without having to do the extra admin yourself. And then finally, we have our full compliance plus insights. This is our fully managed option. So we will do all of your bookkeeping, we will submit your quarterly updates, and we will handle the final declaration. On top of that, you are going to receive quarterly reports and review calls so that you can really understand how your business is performing throughout the year. This is ideal if you want to hand everything over and just focus on running your business. So in short, DIY keeps the cost down if you're having to do the admin. Full compliance gives you peace of mind by letting us handle the submissions, and your full compliance with insights takes absolutely everything off your plate. So thank you very much for joining me today. Have we got any questions? Let me just have a look. I can't see any in the chat box, so please do put them in if you do have any. I did have a couple of questions that came through before the webinar, so I am going to go through those now. Let me I might just stop sharing my screen. Oh, no, wrong one. Okay, lovely. So, oh, I can see some faces now. That's nice. Hello. So a couple of questions that I had before the webinar. So let me just go through those now. As I say, if you've got any more, please do put them in the chat. So what would happen if I forgot to submit a quarterly update? So HMRC are using a points-based system. You get 1 point per missed submission, and when you hit 4 points for quarterly submissions, you are charged £200. Every further late submission after that is another 200 until your points are reset by a compliance period. So it's not, at the moment, it's not as problematic if you forget to make a submission, but obviously I highly recommend that you that you do make sure that you're submitting quarterly within the deadlines. Can I still use my accountant if I have to use MTD software? So absolutely. We work with clients on software solutions anyway. We do a lot of bookkeeping, monthly reporting, things like that for clients anyway. This just basically gives us another thing that we need to do with you, but we're used to kind of dealing with clients working with bookkeeping and, as I say, with the reporting as well. What if my income fluctuates significantly from year to year? So the test for the income levels is based on your previous tax return. So again, at the moment, to work out whether you are eligible for April 26, we are looking at your 24-25 self-assessment return that we are currently preparing and submitting before the 31st of January. And that will then move to the next year. So the 25-26 return will work out whether you are then eligible for April 27. Do I need to keep paper records if I'm using digital software? So you need to keep the backup for your receipts and for your paper records. Now, if we're using digital software, something like FreeAgent or Xero, we can give you access to some receipt capture software. So this means you can take a photograph of the receipt, you can email it into the software, it then stores that against the transaction. So although, yes, you absolutely need to keep your backup for any transactions that you've got, there are ways to do that without having to say keep hold of the paper, or you can upload that into the software directly. I think that was all of the questions. Was there anything else? No one's put anything in, so I will assume that I have covered everything in that webinar and that I've managed to do my job at this end. So obviously, if you do have any further questions, I can see a lot of our clients are on the call anyway. Please feel free to come and join, ask questions to me or to Nitu, Charlene, Sammy that you've got contact with. We're more than happy to answer the questions. Anyone that's not a client, so if anyone's watching this back, not a client, please feel free to come and have a chat with me if you'd like to understand any further. So I'm more than happy to have a chat. So I will be sending the copy out to everybody. Again, if you have any questions after this, please let me know. But it's been brilliant to have you all here. Thank you so much for joining me, and take care. Have a great rest of the week.